The truest AI trade is Bitcoin. The capital structure of this economy is built for slow of what is going to be an incredibly volatile period that has no historical precedent.
This is the force holding the entire stock market at its current levels. According to veteran macro strategist Jordi Visser, this isn't a bubble. It's a standard for the future that has no historical precedent. Today we are breaking down Visser's 2026 blueprint. We'll explore why this moment feels like the 1998 LTCM collapse in slow motion, the virtual run currently happening in private credit, and why the global capital structure is adjusting to a terrifying new reality. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
An economy that has had two parts now for really since 2022. Once we raised rates significantly, and the housing market died, and then we had Silicon Valley Bank, the commercial real estate market died. Because there was so much money thrown into long duration assets in 2021, particularly software, because of COVID and crypto. Think about 2021, 2022, and just how much money flew in. Then the Fed raised rates. Then we've seen long duration assets. It's not just commercial real estate. It's not just the housing market. It is private equity. We're going through the private credit. It's VC. So I think that part of the economy, if you ask anyone that's in those areas, I mean, you know a lot of crypto entrepreneurs. It's been a bloodbath. Housing market, bloodbath. I mean, we're still sitting at all-time lows in terms of, or close to all-time lows in terms of house purchases. And things have been on one side of the economy bad. We've had auto lenders going out. Like the private credit world has seen a lot of defaults. It's seen a lot of fraud. When the tide of liquidity goes out, you get to see who's naked. And we've been going through that. So on that front, everything's been horrible. The problem with the economy and what's driving it now, it's all AI. 100% of everything going on is artificial intelligence. If it wasn't for artificial intelligence, I doubt the stock market would be at the level it is, because we wouldn't be having the earnings. The earnings have been driven, at least until very recently, predominantly by NVIDIA and the Mag 7. That's how we ended up with so much concentration. So it's a very, very strange market and economy that has really no historical comparison. But I think people have to realize that behind everything that's going on right now, and so when the Fed paused, or when they pivoted in October of 2022, a month later is when ChatGPT was released. So you have these two forces of the overhang of rates being higher, hurting all of these businesses. But now you have AI, which has gone from a stupid 100 IQ problem, meaning hallucinations everywhere, to 130 IQ, where Opus 4.6 comes out. And so, as I said when we were at your event, I think people have to be prepared that we're at the beginning of what is going to be an incredibly volatile period that has no historical precedent. And the paper I'm going to write for next week for 22V and my subscribers is, this reminds me of LTCM, and this reminds me of the Quant Quake. Now, in both of those cases, the S&P, I think in 98, the S&P finished up for the year. And if it didn't, it finished pretty close to it. But there was a lot of breakdown of historical relationships. And that's what you're seeing, is that the historical relationships, we have a great economy, jobs will be good. All right. We're not having jobs be good with a great economy. All of those historical relationships are breaking down right now. What happened in the jobs report, which is new. So last month we had 130,000 jobs created?
Allegedly.
137,000 of them were in healthcare. So ex-healthcare, it was a negative number. This month, the reason that we're in negative territory is because healthcare was negative this month. Mm-hmm. Now, that's not going to happen going forward. This was a 1 month thing, but
why do you think that it was negative?
There was some strikes and some other issues that were one-off. And remember, you had bad weather. You had a whole bunch of things which could have impacted the survey and everything along those lines. So I'm going to say that we're still tracking in the same way we have been. I'm a statistics geek. We have not created any jobs now for over a year if you strip out healthcare. And the reason I keep saying healthcare is a different kind of job, and it's very hard to be displaced from AI right now. Eventually it will, but It's very hard to do that. All the other jobs, accountants, legal, all that can be disrupted. AI is definitely killing businesses and bankruptcies. We're seeing more bankruptcies, and I think we're going to see more of them, which means there's job losses. We still have companies. I mean, last week we went through XYZ. This week, you've had Morgan Stanley announce that they're laying off people, Oracle slashing jobs. This is not the normal thing at a time. So I still hear too many people saying, well, the normal job creation, because we don't have immigration and because of demographics, is not that far above zero. BS. Like, this is just complete garbage. And if you listen to people like that, AI is disrupting jobs. It's not going to create mass firing, in my opinion. But we also know that it's going to get worse. So it wasn't as bad a number as I think people are going, but it does show that if you're not creating jobs and you have gas at the pump going higher, which means we're going to see a huge inflation print in the next month, because gas is a major part of the headline inflation number. It may not filter all the way through core, but you're going to see an inflation number that I'm sure, based on what we've seen at gas at the pump, is going to be at 1% or higher. So that's for 1 month. That's an annualized number of 12. We're going to be back in kind of the, oh my God, we're in 2022 period again. And that's coming in the next month. So I think it's just a period of uncertainty, both in the labor market, but this is going to add uncertainty on the inflation side. Because the one thing I will say is on the Iran situation, when you go to Polymarket and things, the betting market does not think this is going to be a short thing. And it's much more difficult to have an off-ramp like we did for Liberation Day, where you just reverse course, and an off-ramp for AI and an off-ramp for a situation with Iran. I'll connect everything you just said back to one thing last year. The trade war ended. Why? Because China told the world they have the world's rare earth. What is the connection between Greenland, Venezuela, Iran, Cuba? When you go into the China, Iran, Russia proxy and you get into the, hey, we control rare earth. All right, let's make sure with Greenland, which has a lot of rare earth, that we have at least the possibility. When we do a deal with the Ukraine, let's make sure rare earth is involved. In terms of China, China gets, I think, 20% of their oil either from Iran or Venezuela. Yeah. So there's a China connection to this whole thing. And remember, there's a Xi-Trump meeting coming up in April, I think. So when you get into kind of the intersection of things, I think the rare earth card was played. I think the oil / let's make sure that you don't have control over these areas the way that you did, that if you're going to shut off rare earth, well, now we can have more control over what goes on in oil and the world. Whether or not that's the true side of it, there's absolutely no doubt that behind all of this is AI. You had the Anthropic fight with the Defense Department. The Maduro situation. You left out the Mexican cartel. Our involvement in using artificial intelligence in moments like this and the ability to do things that we've never seen before, like Venezuela, I think people just have to realize that this is a new world of, again, artificial intelligence that will only intensify as we get into humanoids. Right now, we're just dealing with autonomous drones. And we're seeing that also means that it's not just Iran. If people haven't looked up, go look at what the Mexican cartel has with drones. Like, we're fighting battles with people that actually have advanced military. And I think having the ability of having an advantage in artificial intelligence is something that this administration is very focused on. Whether or not when the midterms come, that'll continue to be there, because I think these are all going to be major issues with the midterm, especially now with gas going up and the jobs market going down. But then when you fast forward it to the next presidential cycle, I think it's absolutely going to be there, because in 3 years, we will be talking more about humanoids being really. That's why whenever we do this show and I meet people either on it, and in particular, right now, financial advisors are kind of the place I'm spending a lot of my time, because they're the voice to investors. Investors that are day traders, they may not have a financial advisor, but with Sylvia and these things, like, there are a lot of people that tune into the show to hear what's going on. These things are unprecedented. Most importantly, they are not going away. So my job with RIAs and financial advisors is hopefully to provide them some kind of a calm backdrop as to what's going on, give them some tools in AI to deal with this. But I think everyone just has to realize that no matter how many questions you ask me today, artificial intelligence is involved in some way, and so is China.
This creates a critical problem for the Federal Reserve. We are in a great economy that isn't creating non-healthcare jobs. Worse, the surge in gas prices guarantees a massive inflation print in the next month, potentially hitting 1% for a single month. an annualized rate of 12%. We are back in the oh my god 2022 period. This isn't normal job creation, this is AI-driven disruption. With Oracle and Morgan Stanley announcing layoffs while the bulls claim immigration is fueling growth.
I've been around many of these scenarios like private credit where retail is trapped. Retail's trapped in products and they don't know what's going on.
So just so people, because many people are probably not following this story, explain a little bit as to some of the data points that we've gotten, Blue Owl, I think it's Blackstone, et cetera, in terms of what's happening.
Yeah, you've had a situation with Blue Owl that's really been in play for a couple months now where, they were getting more redemptions. And the way these things were structured, these funds, a certain amount could be taken out. And this is something that people have to understand is everyone wants to get a higher yield than what they can get on money market funds. So if you can get an extra 500 basis points, and right now, most of these funds were producing 8 to 10% returns, really since 2020. So to be able to get those types of returns, they took in a lot of money because they also don't have many down months because these things don't trade that much. So if you don't have to mark things to market, the returns look great until they don't. And when they don't is when there's a combination of losses and defaults and things happening. So you had Tricolor, you had First Brands, which we talked about in October, and you got some cracks showing up. But then you've had more. And when software collapsed and people realized that anywhere from 13 to 25% in some of these funds was in technology/software, well, then those bonds go down and then people want their money back. And when they want their money back, then these places have to go sell bonds down. And Blue Owl had to sell some stuff to the marketplace that a captive insurer bought and a whole bunch. So that
they got 99.7%.
Yeah. And then this week, Blackstone had a scenario that they had about 1.7 billion net come out. The partners there put up some money and the firm put up some money to make sure that they could get their money back, even though there's a restriction on how much. They wanted to give enough so it still stayed in that level. And then today we have BlackRock. So what is happening, and I've seen this too many times, retail wants their money. And unlike SVB, where you could just go on your phone and get rid of it, there's a run happening. And is it justified? They don't want to sit for the losses that are probably going to happen.
Is it a contagion type thing where, okay, I see, kind of one crack, I see a second crack, I see a third crack. I'm actually not even going to go do the work to figure out whether I'm safe or not. Just give me my money back. And I'm running for the hills just out of an abundance of caution, which then creates so much of this pressure.
It does, but I don't think we'd be in this position if it wasn't for the software stocks.
Got it.
So what people have to realize, and again, this week, BlackRock, and this freaked everyone out yesterday, they had a bond in their private credit fund that was marked at par, 100, a few months ago. And then they announced yesterday, it's a 0. That doesn't happen usually unless there's fraud. So we don't know the details behind it, or at least I haven't read the details on how you could go from 100 to 0. But when that kind of stuff is happening, it makes people scared, justifiably. Now, the private credit market is large. It's estimated to be $2 to $4 trillion. There's interval funds, which are starting to get stories on X as well. These are going to be in the same type of situation. So here's the thing I'll say that's positive. Is this going to take the economy down? No. Does this have a bigger impact than people realize? Yes, because it is tied very, very closely to the insurance industry. And the insurance industry has a tremendous amount of leverage. The companies we're mentioning, Blue Owl, there was an insurance company involved. Apollo has Athene. Blackstone is in the insurance. Like all of these places, some of them have captive insurance companies, and they've been selling stuff to retail. A lot of the big hedge funds just change their liquidity terms in the last few years to 5 years. This will be a story, in my opinion, this year as well. So I think the private credit thing that people are reading about is something that should be on the front of their mind. Is, again, another one of these situations where in a world where things are moving so fast, not just the news impacts this in two ways. One is everyone now knows private credit is an issue because all they have to do is see how fast it's spreading. The networks get a lot of their news now from X, because something that would have taken weeks to be a story is now out there the second it goes viral, because we're all looking at viral stuff. So again, go back to It's a Wonderful Life. The way you found out there was a run on a bank is seeing everyone run to the bank. That's where the phrase came from. Well, now we're having these virtual runs, and I think the private credit market is mispriced, and all credit spreads are mispriced for what software went through. So remember, software fell and stocks started getting volatile, and I talked about my turbulence model, which I sent a big thing out this week to people, you started getting these shakes in early February. And the reason was software was falling so fast. And the reason it was falling fast and then started to impact all these other industries was people don't know what 3 years from now is going to look like. When you're lending people money for 10 years, if you don't know what the world's going to look like in 3 years, how can credit spreads be tight? Because that means the probability of me getting paid back over the 10 years is 100%. I think what they're discounting now is that it isn't, and that means credit should continue to go up and volatility should go up. And I think that's going to be the nature of this year. So people should just buckle up. If you've got FAs, and if there's FAs watching, reach out. All of this stuff is there. And I think using AI to help be able to give you more details on this and provide your investors with some things, I'm trying to help them. But I think at a minimum, you also need to be on top of how to use artificial intelligence.
Private credit is going through, turbulence and pressure. Are you someone who thinks that people who are sophisticated and understand this should be running into the fire and there's going to be lots of opportunity in these distressed assets and all this chaos? Or is this something where you'd be running away from it and saying, the people who are leaving are intelligent and stay away from this stuff?
I don't think it's something anyone should be getting involved in yet. And
we're at the start of the crisis, not near the bottom of a crisis.
Yeah, with assets, I think they're just going through the place. If you listen to one thing I'm saying, all of the capital structure of the world is adjusting to a world where there is no certainty 3 years from now. That means volatility's got to be higher. Number two, multiples have to compress in the equity markets. I'm a deleveraging person. That's the reason why I'm in Bitcoin.
Explain this concept, because I've heard you say this a couple of times. I do not think that most people are paying attention, nor do they understand. When you talk about the equity market deleveraging or the fiat system deleveraging, what does that mean?
If over the next decade, the economy grew by 6% nominally a year, but the S&P 500 was unchanged. Right now, we're at 220% of S&P market cap to GDP. That number is doubled what was considered dangerous before. We've financialized the entire market. This is the reason why back last year, when the government was trying to do what it was going to do, I was on here saying, this is not going to work. You eventually are going to have to throw in the towel on these plans, because if you let the stock market fall 50%, then we will go into a recession because we financialized it. The only way you can exit the leverage in the system is slow moving. Wealthy people get hurt not in losing money in consumption because they're driving a lot of consumption, but if the S&P is unchanged over a 10-year period, and most of the economic growth from a dollar perspective goes to private entrepreneurs. And this is the thing, if you take the GDP of the country, $30 trillion, and you say the market cap of the S&P is $65 trillion, that's how we get to 220%. What if the S&P 500 in 10 years is still 65 trillion, but GDP is now 60 trillion? Well, we've lowered that. Nobody lost money. They were just debased, right? On the other side, if the revenues left the S&P and went into these private companies, these little entrepreneurs making lots of money, well, we got the redistribution without a tax, and it happened through debasement. Now, if that occurs, this is where I believe Bitcoin will soar, because the money will be moving away. Now, I can give you a lot of reasons why I believe this is going to happen, but instead of it being viewed as bearish, which I am not, I just believe this is a debasement tax on the wealthy that is going to the entrepreneurs, driven by the democratization of intelligence and the democratization of the financial rails, opening up the ability for the middlemen to be extracted. That is the whole nature of crypto, is if the middleman can't make the money, and if AI disrupts the wealthy people, because now a single person can build a business worth $1 billion, and it would be a business that Google would own in the past, and that's not the case, then everything is shifting away. And I believe that is going to happen, and I believe it's the healthiest way for this to actually end, as opposed to a revolution and a war. The revolution is happening where the OpenClaw people are winning. If your kids aren't using OpenClaw yet, they should be. Sponsor it. Get involved in it. Get them a Mac Mini. Get them a MacBook Pro. Get them using this stuff and let them start building stuff with AI agents. Everything still gets back to the connection between driving revenues and driving GDP. Because at the end of the day, GDP is just a representation of all the transactions. So if you invest in foreign markets, in my opinion, as an overweight position and you're underweight the S&P 500, which has worked significantly since Netscape. I mean, we own technology. So if for the next decade the S&P is flat, but a private business is doing phenomenal, and then foreign markets are doing well, I think the way to make money is to be invested outside of these companies. I think commodities are going to do great because we have to build out everything that we need to power the AI. Tokenization is going to come and allow you to invest in all of these private companies that are there. They're going to trade like prediction markets. That's why prediction markets are real, because a startup business that never becomes monetized, never goes public because they don't need the capital, and they just grow rapidly and they get to $1 billion like a Cursor, maybe Cursor's done. But if you could have traded it and they grew to that level and then you got out of it, you don't care if it goes back down. Axie Infinity existed and then it was gone. The crypto world, you get used to things pop up, they go down. I think people have to get used to the speed of AI and the monetization of a great idea that people want right now into something that grows and then it stops. And I think we're just moving time. I keep saying it time and time again. When I use the Supersonic Tsunami thing I don't think people listen. Like Elon's telling you, fast and powerful. That's what AI is. And so the capital structure is not built for that. The capital structure of this economy is built for slow. The risk models of a large quant hedge fund or a multi-strat hedge fund is based on COVAR, which is the historical relationship between volatility and the correlation of assets. That's why I say this reminds me of LTCM in slow motion. It reminds me of the Quant Quake in August of 2007. And I do believe that this is going to play out this way this year, but it's not a bearish thing. It is a up and down thing. If you're a day trader, it's a phenomenal period. So I have tons of names that I hope the market sells off 10% so I can go in. Last night we had Marvell report. Marvell is a big part of the ASICs explosion that's going to happen. I love finding companies like that. So I think you can stock pick. I think you can day trade. I still love Palantir relative to Microsoft. I still love Bitcoin relative to the software sector. I actually think it's a more enjoyable time for people that are doing their homework in AI. I think for people that have been passive and just sitting in things, which is what private credit was about, and it's what the S&P 500 or the passive indices are, it's a more active environment. And I think everyone knows that because they watch their kids. Why don't you like baseball? It's boring. Why don't you want to play golf? It's too slow. Everything is about speed now. And I don't think the older generation tends to want speed. The tasks that it's doing for me are freeing up time that to me is ridiculous time that I have to spend. The cutting and pasting of all this, the putting it into Notion, it really is a productivity thing. It doesn't come up with novel ideas. So I listen to one of the podcasts, and as I show every week, when I get the transcript and I go, what are the most important insights out of this that I can make money off of? There's nothing. And that's why I have to listen to the podcast. So this one in particular was the guy named Jerry Murdoch, Insights Partners. It's a great one. I'll send it to you. But he just talks about how much the world is changing. And then you had Josh Wolf send out something to his LPs on the fact that he's worried about all startups right now. And the reason is because of the speed. So he's Lux Capital. All of a sudden now, a lot of people with inside Silicon Valley are talking not about software is dead, this is going. It's more the nuances involved, which this is an important thing. And this is changing who the winners and losers will be. But more importantly, the architecture that fits into a firm. What I didn't bring up with the Iran thing, which I kind of teased, if you're a company and your sensitive information is going through ChatGPT Enterprise and up to the cloud, and you think you're safe, I think we're at a point with the Mexican hacking at the government that all companies and large enterprises, Iran is a very sophisticated country when it comes to cyber. I don't know what's going to happen, but I do know this. More and more people, both in Washington and the banks, are warning about an attack. And the reason they warn people is because they want to be able to go back and say, I told you this was going to happen. There were plenty of warnings before 9/11, before 9/11 occurred, in terms of people knowing that, hey, we don't have enough protection. We're letting things happen that shouldn't happen. I think cybersecurity is going to be a major issue. And this is where you get into the thing of, I want to do some work in the sandbox that is protected and anything can go wrong there. But for my stuff, I don't want you guys being involved in it. I don't want to be exposed to cyber. And that's where I say when that cyber attack occurs, Bitcoin and cryptography all of a sudden is going to be another important thing, because as much as the RSA work that CrowdStrike and all these guys go through, I think the blockchain and Bitcoin is going to be another thing that people think about. Oh my God, we need to have thing on chain because of the cyber risks. Doing what everyone does when they write, which is when you go to school and you have to write a paper, you go to the library. And you know what you get from the library? Information that you then turn into a paper. AI is no different than that. I come up with the concept. I come up with I add my personal anecdotes and parts into almost everything I write. Like I'm the one I mentioned today about comparing this to LTCM and the Quant Quake. I was involved in both of those. I'm doing it from a place of being there. Am I doing research to add value into it? Because I don't remember everything with LTCM. Of course. Is AI helping with that? Of course it is. Why would I go to the library and go waste time? So for all you people out there, this is AI written. Fiction and AI generated, I can tell, because it's just, there's no personal anecdotes and it's just like blah that comes out. I write a Substack that gets a lot of people to read it. I think it's because I'm coming up with ideas.
Uniqueness.
Yeah, uniqueness that goes. And I think that is what will separate good content from bad content going forward. But AI, as I've seen it right now, it can't create good content because it doesn't have the context that people want to hear. Writing a story about LTCM and the Quant Quake wouldn't matter last year during the Liberation Day. Right now, what we talked about, there is no doubt that jobs are not being created while the economy is growing. Inflation's going higher, but job rates are going down. It puts the Fed in a difficult position. AI is creating an environment where for people to fully, I think, be able to accept the chaos that's happening, part of that's going to happen with time and just getting used to all these things. But part of it is feeling like you're expecting them. And there was one thing in there, and I can't remember the exact line, but I'm going to use something from that. So there was one fact in there. What he said in there, George Washington, he said, a quote that I said was, to be prepared for war, basically is the insurance for, well, that's the theme with AI.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.